Welcome to the lecture on capital structure and the M&M theorems. M&M stands for Modigliani and Miller. These are two economists who propose some theorems that have really shaped the thoughts of corporate finance. They shape the thinking about capital structure, but also about corporate finance more generally. So we're going to tackle those today. We'll start by discussing capital structure broadly. We'll define it. In particular, when we talk about capital structure, we're talking about the mix of financing for a firm. So we're dealing with this balance sheet identity. Assets are equal to debt plus equity. Capital structure is the mix of debt and equity. Do you use a lot of debt to finance your company? Do you use a lot of equity? Do you use half and half? How exactly do you raise money for your company? That's the capital structure question. We want to know, does it matter? Does it make any difference if you use all debts or all equity or whatever mix you choose? Should we even care about that at all? So Modigliani and Miller, they're going to help us think about this. They have a couple key propositions. The first proposition is that no, capital structure is irrelevant. It doesn't matter for us in corporate finance. The conclusion is that the market value of the company is independent of its capital structure. They're going to argue that the only thing that matters are the assets. That's what generates the cash flows. That's what matters. How you choose to finance those is irrelevant. So we'll derive that and talk a little bit more about its importance. Then we'll move on to the second proposition, which follows from the first proposition. The second proposition is that while the value of the assets is all that matters, it doesn't matter how much debt or equity you use. The debt and the equity interact with each other. If you use a lot of debt, that's going to make the equity more risky. You have to pay the debt holders first or else you go bankrupt. So when you take on more debt, that means you give all the safe cash flows to the debt holders. All that's left over then is the risky stuff, and that's what you give to the equity holders. Okay, so that's in words proposition number 2. You take on more debt, your equity is going to get riskier. Your required returns on the equity have to go up. Then we'll introduce corporate taxes. So you won't be surprised to learn that in order to make these propositions, proposition 1 and proposition 2, Modigliani and Miller have to make certain assumptions. They make certain assumptions about the world that are very important. One assumption that they make is that there's no taxes. We're going to relax that and see how that affects their conclusions. And it's a relatively straightforward direction. We take away one assumption and we see how that feeds into these conclusions. Now we're going to see that capital structure can matter. In particular, we're going to see that debt, under the U.S. tax system anyways, a debt becomes preferred under the U.S. tax code. Then we'll take that thought and extend it a little bit further for personal taxes. This is called the Miller model. Does it matter, does corporate finance matter if we can consider how individuals are taxed? And we'll see that, yes, if individuals are taxed differently on their debt income versus their equity income, then that could shift the balance toward one or the other. Maybe firms prefer more equity because they're taxed less on their equity investments than on their debt. So that's the big picture where we're going. Capital structure, I've already defined it a little bit. It's the mix of securities with which the firm funds itself. Okay, so we've got debt or equity. Those are the two big ones. These are how we raise money to buy assets and to run the firm. When a company issues securities, those are claims on the cash flows for that company. So for me, in my 401k, I buy stocks. That's an asset for me because those companies are generating cash flows and they're going to pay me as the equity holder. So it's a good thing for me to own stocks. But from the company's perspective, it's on the right-hand side of their balance sheet, right? They owe me cash because I gave them money, right? I paid for a stock, I bought some stock, and now the company needs to send me dividends in the case of equity, or they need to send me interest payments in the face of debt issuance. So the security is a claim against the company's assets, against the issuer's assets. So that's why it shows up on the right-hand side of the company's balance sheet. So anything on the right-hand side, we have debt and equity here, but you can think of more esoteric sources of financing, anything that the company uses to raise money. That's part of the capital structure. The big question is, does it matter? Right? This debt plus equity question, as we can think about a pie graph. We can think about drawing the company as a pie. We know that the value of the company is equal to debt plus equity. So you can think of that as the size of the pie. Okay. The question becomes, does the pie itself change shape when you use different mixes of debt and equity? Okay, so for example, suppose you use half debt and half equity. Maybe then the firm looks like this. Okay, you cut it up, you give half of the company to debt holders, half the company to equity holders, we get this pie. Well, what if instead of giving half to debt and half to equity, we gave like 80% to debt? What happens then? Well, maybe the pie gets bigger, right? If we give more to debt holders, maybe the entire firm increases in value and we get a bigger pie. Okay, or maybe alternatively, if you use a lot of debt, maybe you use 95% debt, perhaps the firm value shrinks. Maybe the pie gets very small if you're using too much debt. Okay, that's the question we're trying to get at. Does it matter? Does the total value, the total size of the pie, does that change when we use debt versus equity? Our goal in corporate finance is to make the firm as valuable as possible. We want to make that pie as big as possible. Maybe one way to do that is by this mix of financing. So who's going to help us think about this? We said Franco Modigliani and Miller are two economists who have really shaped the thinking on corporate finance and capital structure. They had a very famous paper where they argued that the value of the firm is unaffected by its capital structure. Okay, it doesn't matter. The size of the pie is going to stay the same whether you use debt or equity or any combination. They said that all that matters is the assets. Okay, so we pull up the balance sheet identity again. They said that the only thing we care about that sets firm value are the assets. And then debt and equity, that's just how you cut up the assets. You're just cutting up the pie a little bit between debt investors versus equity investors. But the only thing that determines the size of the pie itself are the assets. Okay. So that was Modigliani and Miller. That's their argument. We're going to derive that and then later on think through their assumptions. The first proposition, Modigliani-Miller Proposition 1, we're going to cover two propositions today. The first one is that the value of the firm is unaffected by capital structure. We've hinted at this. All that matters are the assets, not the capital structure itself. In order to get that conclusion, they have to make a fair number of assumptions. The main one we're going to focus on are no taxes. They assume that there's no taxes in the world, keep things simple. We're going to be able to address this. This one's actually pretty easy to address. We'll see how Modigliani-Miller's assumptions can affect their conclusions here. Okay. But they make other assumptions that should look a little bit familiar to us. In particular, they assume that there's no cost of bankruptcy or financial distress. So if the company goes into bankruptcy, what happens? Well, you just give the company to the debt holders. Instead of having the equity holders run the company, like is what usually happens. Well, if you go bankrupt, you just give the company over to the debt holders, and then the debt holders continue to operate the company, no problem. It doesn't cost anything just to shift ownership from equity to debt. That's an assumption that they're going to make. They also assume that there's no transaction costs. So if you're going to sell more debt or equity, it's easy to do that, right? It's easy to raise money when you need it. They assume that firm managers like the CFO or the CEO, they don't have private information about the prospects of the company that investors do not have. So you can imagine that that's probably not correct. If you're going to buy a stock of Tesla, you probably don't know as much as Elon Musk knows about the company. And related to that, there's no agency problems between the managers and the investors. This means that there's no conflicts of interest. When you buy a share of Tesla, you know that Elon Musk is going to do what you want him to do. His interests are the same as yours. Okay, so we're assuming away any conflicts of interest between the CEO and the investors, or even the middle managers or anybody. There's no problems there. Another assumption is that investors can borrow and lend on their own account on the same terms as the firm. So if the firm can borrow at a 3% discount rate, 3% interest rate, then you as an individual investor can borrow at a 3% interest rate. And finally, they assume that markets are perfectly competitive and efficient with respect to public information. Okay, so the stock price is always kind of right. If a company is going to sell stock, it's important that the price of that stock is correct. If the price is too low, then the company is going to be selling stock at too low of a price, and they're going to be kind of losing money that way. So we need that the stock prices reflect all the information about the company's prospects. Okay, so these are kind of a lot of assumptions. These are very strong assumptions. We've seen these before. If you recall the lecture on complements to the NPV, we said that when does the NPV rule work very well? NPV works well when financial markets are working well, and it's easy to raise money at a fair price. Okay, that was our conclusion then. If financial markets are working well, all you need is NPV, and that's going to do a great job at making good decisions. That's this second to last bullet here. If the financial markets are working well, then Modigliani and Miller's assumptions are going to be reasonably correct, right? They're going to be an approximation of reality. We know that these are all strong assumptions that get violated, but if the financial markets are working well, then these are what we mean by that. Okay. I want you to keep this in the back of your head, that these are very strong assumptions that are violated. We can, look and see that companies pay taxes. We can look and see that sometimes investors have different interests than firm managers, or they don't know as much. So what's the point of doing all of this? I want you to keep that in the back of your head. We're going to revisit this later. What's the point of making these strong assumptions if they don't reflect reality? All right, so let that kind of germinate a bit, and we'll revisit. But for now, this is what we're going to do. We're going to assume that markets work very well, kind of extraordinarily well. It's helpful to understand M&M with a kind of simple example. You'll see the logic, and then you'll be able to kind of draw the conclusion. So here's a fictional company, Macbeth Spot Removers Incorporated. We're going to start with them being 100% equity financed. And then we're going to change their capital structure. And we're going to see if you change the capital structure, does that affect the value of the company? So just some data on this company. They've got 1,000 shares outstanding. Shares are trading at $10 per share. So that gives you a market value of equity of $10,000. They're 100% equity, so that's the total value of the company, is the $10,000. There's 4 kind of states of the world that we can find ourselves in, right? So there's uncertainty. We don't know what's going to happen to this company. There's 4 possibilities. Call these A, B, C, and D. A is the worst case. Our operating income in state A is only $500. B is better. We have $1,000 in operating income. C is that middle case. That's going to be our expected outcome. That's what we think is going to happen. Then we're going to get an operating income of $1,500. And in D, that's the good state. That's the best possible case. We get an income of $2,000. Okay, so let's just think through these results for the equity holders. In the expected case, if you're getting an operating income of $1,500 and you have 1,000 shares, then what's the earnings per share? Well, it's $1,500 divided by 1,000. So that's $1.50 per share. What would be the return on equity therefore would be that $1.50 divided by the $10 price. Right? If you buy a share, you're paying $10. And what do you get back? Well, you're getting back this $1.50 in earnings. So the return on equity would be 15%. And you can do the same exercise for all of the outcomes. If you only earn $500 and you've got 1,000 shares, then that's 50 cents per share. We have a return on equity of 5% therefore. Okay. We want to see what happens when we change the capital structure. We start with 100% equity, but now suppose we switch to 50% debt and 50% equity. Okay, that's the only switch. We still have the same 4 outcomes. The operations of the company are still the same. So if you look at the operating income, these are the same as before. We have $500 in A, $1,000, $1,500, $2,000. Okay. What's different now is instead of having $10,000 in equity, we have $5,000 in equity and $5,000 in debt. We'll keep the price per share the same. So if we have $5,000 in equity and the price is the same, then we have half as many shares. We only have 500 shares. We need to say something about the interest on the debt. We have $5,000 in debt, so let's just assume that the interest rate on the debt is 10%. Therefore, the company is now paying interest of $500 on the debt. Okay, so this is the new line that we added. We have to make an interest payment now that we're taking on debt. Before we weren't taking debt, now we are, so we have to pay interest. So in the bad state of the world, part A, we have $500 in income, but now we have to pay $500 in interest to service the debt. So that means we have nothing left over for equity holders, and we have a 0% return on equity. In the expected case, we still have the $1,500 in income. We have to pay $500 to debt holders. That means we only have $1,000 left over for equity. Now, we only have 500 shares. Before we had 1,000 shares. We only have 500 now. So that $1,000 that we have for equity holders, that actually translates into a $2 earnings per share. Before we had $1.50 earnings per share in the expected case. But now since we have fewer shares, we have a higher earnings per share and thus a higher return on equity. You pay the $10 per share and you get $2 in earnings from that. So that's a 20% return. Okay, so here I'm just laying out two possibilities. As an investor, do you care whether the company uses 100% equity or 50% debt and 50% equity? Should you care about this? That's the critical question, because if you care, then you're willing to pay more for the company if it does what you want. So let's think about, just to fix ideas here, suppose you look at this and you just kind of naively think, well, my earnings per share is $2 if I use debt. Whereas if I use all equity, my earnings per share in expectation is only going to be $1.50. So let's just say, this is going to be wrong. We'll see that this is the wrong way to think about this later. But let's just say that you prefer 50% debt and 50% equity. You're an equity investor. You would rather have a $2 earnings per share than a $1.50 earnings per share. So you like this case better with half and half. So you call up the CFO and you say, I'm an investor, I'm an important investor, I own Macbeth, I want you to take on debt. Suppose the company starts with 100% equity and you're trying to push for this move to take on debt. The CFO says, yeah, I can't be bothered with that, I'm not going to do it. What could you do as an investor? Doesn't make any difference to you. You like these cash flows better. Okay, you would rather have these four earnings per share, either a $0, $2, or $3. The CFO says, nah, I'm just not going to do that. And then you're kind of stuck with earnings per share of 50 cents, $1, $1.50, or $2. So what could be one way that you can kind of undo the CFO's decision? If you, again, think back to that lecture on complements to NPV, we made similar assumptions here when we were talking about Jane Fonda's problem. Remember, she had this company she owned, Time Incorporated. She wanted to have money at a certain time, and the company wasn't generating money at the exact time that she wanted it to. And so we thought, well, what could she do to kind of offset that issue? All right, if the CFO is not going to change the company's actions, what could the investor do instead in order to get what she wants? Same thing here. I want you to think about, suppose the investor takes on a loan. you want these cash flows. You want the cash flows that come from 50% debt, 50% equity. The CFO says, no, I'm not going to take on any debt. Well, you as the investor, you can take on debt if the CFO is not going to take on as much debt as you want. So let's walk through that thought experiment here. Suppose that we're at 100% equity, but you want to get the cash flows from the 50% equity case. Well, you could borrow $10, and with that $10, you buy a share. So you start with, let's say you start with $10. If you want to get the 50% debt outcome, you borrow an additional $10. Okay, so now you personally have $10 of your own money, and you borrowed $10 from the bank. You have $20 now. You go and you buy 2 shares of Macbeth spot removers instead of just the 1 share. If you buy 2 shares at $10, and we go back to this 100% equity case, you own 2 shares now. So on each share, you're going to get 50 cents per share in case A, $1 per share in B, $1.50 in C, and $2 in D. You're going to get that for each share, but you have 2 shares. So your earnings total from that scenario are going to be $1, $2, $3, and $4, right? You're multiplying the earnings per share by 2. Now that's not the end of it. You also have to pay interest on that loan that you took out. You took out a $10 loan to buy 2 shares, to buy that extra share. If your interest rate's the same as what the company would be paying, you're paying a 10% interest rate. You borrow $10 and you have to pay 10% rate. That's a $1 interest payment that you have to make no matter what. Okay, so here we're replicating, we have these earnings on 2 shares, 50 cents times 2, $1 times 2, $1.50 times 2, $2 times 2. That gets you your earnings on 2 shares, but you have to pay interest on the $10 you borrowed. So that's $1 no matter what happens. Good times or bad, you're paying $1. How much is left over? Well, if the bad state of the world occurs, you have $0. In the expected case, you have $2. In the good case, you have 3. Right? This is what's left over after you get your earnings and you pay off your debt. As an investor, you're left with these cash flows, and you're left with these returns, therefore. You had $10 of your own money. You get a 0% return in part A, a 10% return in C, 20% in C, and 30% in D. Now, this should strike you as familiar, because that's exactly what you would get in the levered equity case. If the company if the company used 50% debt, what return would you get as an investor? 0, 10, 20, 30. If the company doesn't take any debt, but you take on 50% debt, your returns will be 0, 10, 20, 30. Right? It's the exact same. And so under the assumptions of Modigliani-Miller, you don't care what the firm does, because you can always undo it. So if the firm doesn't take as much debt as you want, that's no problem. You can just take on debt on your personal account and use that to buy more equity. It would be the same thing. It would be equivalent to the company taking on debt. Or suppose it goes the other way. Suppose the company's taking on too much debt and you're not comfortable with that debt. What could you do? Well, what's the opposite of taking out a loan? You would kind of buy a loan, right? You could buy the company's debt, and that would undo the effect of the company taking on debt. You would be lending money to the company, essentially. And so the final cash flows to you would be as if the company didn't take any debt. Right? So you're just completely undoing whatever the CFO wants to do. You have the power to do that. So therefore, investors don't care. Investors aren't going to value the company more because of its capital structure, because investors can just do that themselves without any problem. Okay. That's the assumptions of Modigliani-Miller, that investors can raise money themselves on the same account as the firm. And if they can, then who cares what the firm does? I'll just do whatever I want myself. that's a big conclusion, because that means not only is debt versus equity irrelevant, it doesn't matter if Macbeth uses 50% debt or 100% debt, whatever, that's irrelevant, but any type of financing is irrelevant. So any type of contract that you can write to raise money is irrelevant because investors can do the same thing. And so there's all sorts of different ways to raise money. You could use, preferred stock versus common stock. Again, it doesn't matter because investors can undo it. You could use, a fixed rate debts versus a floating rate debts. So you can fix the interest rate versus allow the interest rate to float based on kind of aggregate conditions. Again, it doesn't matter because investors can just undo it themselves. It doesn't matter if you use very safe debts, investment grade debts versus kind of junk debt, very risky debt. Again, it doesn't matter because investors can do the exact same thing. So CFOs and managers, they can't change the value of the company by changing its capital structure. Okay, that's the punchline for Modigliani-Miller, Proposition 1. It's an irrelevance theorem. It doesn't matter what the firm does. But remember that thing I told you to keep in the back of your head. In order to get this proposition, we had to make certain strong assumptions. Okay, so we're going to return to that and try to interpret the theorem when we revisit those assumptions. When you call something a proposition, it sounds abstract and kind of complicated. So years later, when Modigliani won the Nobel Prize in economics for essentially this result, and he was asked to explain it in kind of simple words, right? When the newspapermen would write the papers, they need to have a headline. They need to explain this to the layman. What is your fancy result? What is this fancy proposition all about? They asked his colleague, Merton Miller, his longtime colleague and collaborator, to explain it. So he had about 10 to 20 seconds to explain M&M Proposition 1 to television viewers. Okay. This was the first attempt. This is my favorite attempt, but this is his first shot. He said, think of the firm as a gigantic tub of whole milk. The farmer can sell the whole milk as it is, or he can separate out the cream and sell it at a considerably higher price than the whole milk would bring. That's the analogy of a firm selling low yield and hence high-priced debt securities. But of course, what the farmer would have left over would be skim milk with low butterfat content, and that would sell for much less than the whole milk. That corresponds to the levered equity. The M&M proposition says that if there were no cost of separation, and of course no government dairy support programs, the cream plus the skim milk would bring the same price as the whole milk. Obviously, this isn't going to fly on TV. This is a very complicated sounding analogy. So TV folks looked at themselves in horror. They said, okay, that's too long. Even this thing is too academic. You have to simplify it a little bit more. So what does he do? Well, he says, okay, picture the firm like a pizza. The total value of the firm is as a pizza. No matter how many slices you carve it up into, the size of the pizza remains the same. And so this is contra the old joke, right? You order a pizza. They say, well, would you like it cut into 6 pieces or 8 pieces? Say, well, I'm feeling hungry today, so I better make it 8, right? It doesn't matter how many slices you cut it up in. The size of the pizza is the same. That's the proposition, right? It doesn't matter how you divvy it up. If you think back to our pie models that we had on the whiteboard before, it doesn't matter how you cut up the pizza, the value of the firm is going to stay the same. So whether you cut it up with 50% debt, 50% equity, 90% debt, 90% equity, we're going to get kind of the same thing. So here would be, the pie if we used mostly debt. Okay, it's going to be the same size pie, but it's going to be just different proportion. You're just cutting it up differently. So here would be 25 and 25, right? Here would be all equity, right? The size of the pie is the same. You're just cutting it up into pieces differently. Okay. So does this mean that corporate finance is irrelevant? This is a class on corporate finance. We've just proved that it doesn't matter what you do with corporate finance. All that matters are the assets, not the financing itself. Well, no, right? We care about corporate finance. How does Modigliani-Miller help us think about finance? So what is the point of doing this whole exercise? Well, recall all of those assumptions that we made. You can pull up the whiteboard. We made lots of assumptions about, no taxes, no cost of bankruptcy, no information problems or conflicts of interest. And we had a few others, right? So we had all these different assumptions. And what we did is we said, okay, all these assumptions imply corporate finance is irrelevant. Capital structure is irrelevant. That was the logical step we took. Make a list of strong assumptions, conclude capital structure is irrelevant. Well, this is actually very powerful because logically, if you have something like this where A implies B, what do you also get out of that? Well, logically, it tells you that if not B, then it must be not A. If these assumptions imply a conclusion, and if the conclusion doesn't hold, then the conclusion, then one of those assumptions must be violated. Okay, so suppose capital structure is relevant. Suppose capital structure does matter. Well, that means that at least one of those assumptions is violated. That's the power of Modigliani-Miller, is that there is only a handful of assumptions. So for finance to matter, broadly, capital structure for one thing, but finance more generally, for finance to make any difference at all, it's got to be that one of these assumptions is violated. So let's pull up that list of assumptions real quick here. Because this also means that if you get a job in finance, which most of you are going to do, if you're working in a finance role, well, why would a firm need you? Right? What's the point of hiring you if finance is irrelevant? Well, it must be that your job is focusing on one of these issues. Okay, so if you do tax accounting, right, you're trying to efficiently make decisions to manage the company's taxes. Or if you're working in, say, a treasury role, you're trying to maintain liquidity without hitting bankruptcy. Right? So there you're going to be at the second bullet, you're trying to avoid costs of bankruptcy. Suppose you work in accounting, okay, and you're making financial statements. What are you trying to do? Well, you're trying to convey information that you have in the firm. You're trying to convey that to outside investors, right? So you're trying to alleviate, this fourth bullet point. Or say you work in asset pricing. Suppose you're, trading stocks. Well, what are you trying to do? You're trying to make sure that those stocks reflect all the information that's out there, right? If the stock prices deviate from the fundamental value, you want to put them back to the fundamental value. What are you working on? Well, you're working on this bullet. You're trying to make sure that the prices are competitive and efficient with respect to information. So if you're working in finance, dollars to donuts, you can pinpoint one of these assumptions and say, that's why I'm hired. That's the value for my job, is because it's one of these issues that gets violated, and I'm trying to fix it, right? I'm trying to make the world align more closely with one of these assumptions. So that's the point here. By itself, if you're just cutting up the pizza pie, it doesn't matter. The size of the pie doesn't change. However, it could be that changing the capital structure reduces taxes. That was one of the assumptions that M&M make. That's the assumption we're going to focus a lot of time on in this class, is how do taxes interact with corporate finance. So if that's true, then corporate finance may matter because of the violation of the no tax assumption. So whenever you're facing a financing decision, or again, getting a job in finance, you have to think through the M&M assumptions, because one of them is going to be violated and one of them is going to be kind of the source of value creation for you as a finance professional. That brings us to the second Modigliani-Miller proposition. The second proposition deals with the risk, the risk of debt and equity and how these things interact with each other. We alluded to it a little bit in this first bullet point here. When you change your capital structure, the risk of the debt and the equity changes. Okay. Now that doesn't affect firm value, because we saw that investors could do the same thing on their own through what's known as homemade leverage. Right? With Macbeth, you can take out a loan in order to replicate a levered firm. So investors don't care about that by itself, but the risk does start to shift when you change your capital structure. And that's the focus of Modigliani-Miller Proposition 2. The second proposition is that debt increases the risk and the returns to shareholders. Financial leverage increases the risk and returns to shareholders. Now, if you think back to the description about the whole milk and the cream, that's what Miller was getting at. He says if you take the whole milk, you can separate it into stuff that's very safe, right? The cream. But then if you take out all of the cream from the whole milk, all you have left is the skim milk, which nobody likes, right? Just kind of watered down milk. That's the equivalent of risky equity, right? You take out the very safe cash flows, you take out the cream, and all you have left over is the skim milk. That becomes the equity when you take on debt. Okay, so the whole milk now becomes separated between the debt part, which is very valuable, the cream, and the skim milk, which is now less valuable because it's very kind of diluted water here. Okay, so that's the analogy that Miller was getting at here. That's capturing both M&M Proposition 1 as well as Proposition number 2. When you take out the safe cash flows, the debt, that means that the residual, the skim milk, is worse, right? The returns to shareholders have to go up because the risk goes up for the shareholders. We've seen this already in the Macbeth example, so I'm going to just remind ourselves what those numbers were, and then we'll talk through it. This was the return on equity possibilities for Macbeth if there was 100% equity financing, right? 5%, 10%, 50%. If we have 50% debt, 50% equity, we had these returns for equity, 0, 10, 20, and 30. So let me just put these in a graph together. On the y-axis, we have the return on equity. We have all the different outcomes, right? A, B, C, and D. We have the blue bar, which corresponds to the firm if it uses 100% equity. And we have the red bars, which is the 50% debt, 50% equity scenario. What you see with 100% equity, we get 5, 10, 15, 20. There's variation right there. There's kind of bad states of the world and good states of the world. But the variation is much smaller than if we use 50% debt. In the red bars, right, you can get as little as 0, and 0 is worse than 5. On the upside, however, the red bar is much higher. Right? You can get a 30% return if things go well, whereas if you use all equity, you can only get a 20% return. Okay, so this is just mechanically what happens when you add debt. Notice what's happening with the cash flows when we add debt. This interest payment on debt, 500, 500, 500, 500, that's occurring every period, right? Whether things are good or bad, right? Best case in scenario D, worst case scenario A, you still have to pay the debt holders, right? You can't go bankrupt. The debt holders have to get paid no matter what. So those are safe cash flows. You're giving the safe cash flows to the cream, in Miller's example, you're giving the cream to the debt holders. That means that all of the risk gets concentrated for the equity holders. All of the risk for the entire company gets kind of crammed into fewer shares now. We only have half equity instead of 100% equity. So all of the risk gets squeezed into half of the firm instead of getting spread out over the entire firm. Okay, that's why we think of the levered equity as this diluted milk. It's the skim milk. It's less valuable because it's just got a lot of risk in there that we don't like. The total risk for the company stays the same. If you look at what's going on with the operating income, right? The operating income is the same whether or not you take debt or not. It's just that all the risk that's there gets squeezed into a smaller space, and the equity holders have to bear all of that. So leverage is going to increase the return. We see this in Macbeth as well. If we look at the expected outcome, when we use debt, we get a 20% return, whereas we only get a 15% return if we don't use any debt. Okay, so it's increasing the return, but it's also increasing the risk that the equity holders have to bear. So this is one case where there is a relationship. This type of risk corresponds to a higher return. The variation in earnings per share for the equity holders is much higher when the firm uses debt, but the total dollar risk stays the same. The dollar risk just gets squeezed into a small number of shares. Okay. Algebraically, it may help you just to walk through it because the math is not difficult. It's just a couple lines of algebra. So we'll walk through it. It all starts with the accounting identity. Assets equals debt plus equity. We're going to start here and just derive Modigliani-Miller Proposition 2. And again, it sounds too abstract, sounds too academic. So I want to walk through just 2 lines of algebra so you can see it, kind of feel it for yourself. I'm going to rewrite the accounting identity in returns. So instead of writing assets, I'm going to think about the returns on the assets. The returns on the assets get divided between the debt holders and the equity holders. So the debt holders get some return and the equity holders get a return. Now, it's not quite a simple sum like this because the company may use more debt than equity, right? So you don't just add up the returns to get the total return. Rather, it's going to be a weighted average. You're going to take how much debt the company has and multiply that by the return on the debt. Okay, so this is the fraction of the company that is owned by debt holders, and debt holders are getting a return RD. Likewise, there's a fraction of the company that's owned by the equity holders, and we multiply that by RE, which is the return that the equity holders are getting. Okay, so in words, the return on the assets gets divided between debt and equity. In proportion to how much of the company they own. Another way to say this, if you want to go in the opposite direction, is that the return on the assets is the weighted average return on the financing. So that's how we can go from the balance sheet identity to something that looks like returns. With this in hand, I'm just going to solve for the return on the equity. Remember, Modigliani-Miller Proposition 2 is saying that the returns on the equity go up when you take on more debt. So I'm just going to do two steps, solve for the return on equity to show that just algebraically. We're going to solve for the return on equity. I'm going to subtract off, I'll subtract off the debt term from both sides. Okay, I just moved the debt term over to the other side of the equation. Now I'm going to multiply both sides by debt plus equity divided by equity, right? I want to get rid of this term so that I leave the return on equity by itself. when I do this, you can see pretty straightforward that I'm going to distribute this outside fraction to each term. That didn't work as well as I wanted. So I'm just distributing this outside fraction to each term in the middle. If you look at this term, d plus e divided by e, well, that's the same as d over e plus 1. So I'm going to break that into two pieces. So I'm just pulling out, I'm distributing that RA to each piece in the numerator there. So I get d over e times RA plus e over e times RA. And obviously that's just 1, so I can get rid of that whole thing. And then with this term, you notice that the d plus e is in the numerator here and it's in the denominator here. So those are going to cancel out. So all I have is d divided by e times rd. Lastly, I'm just going to combine like terms. We have this d over e term here and here. So I'm going to put those two things together. And that's it. That's the couple lines of algebra. You see it now, so you just know that it's a algebraic result. That when I take on more debt, this fraction here, debt over equity, that goes up. If that's going up, that means that the return on equity should also be going up. So that's it's very kind of simple to get a Nobel Prize for this, right? So when leverage goes up, d over e goes up, the risk and the returns, the required return on equity, has to go up just kind of mechanically. Okay, that's illustrated in this example, but also it's shown algebraically. You can work through the Macbeth example and calculate what's happening to the equity when you use 100% equity versus 50% equity. I'm just going to walk through the formula that I just derived. If you have 100% equity, well, then debt over equity is 0. So the return on the equity is just the return on the assets, 15%, right? You're just getting everything. Everything goes straight to the equity holders. But when you take half debt and half equity, well, what happens with d over e? That's 1 now. You have as much debt as you have equity, so the debt to equity ratio is 1. Plugging all of that into the return on equity formula, we get the 15% return on the assets plus 1 times the return on the assets minus the return on the debt. So we get a higher 20% return on equity when we use more debt. And so that's what this middle bar was showing. When we take on debt, we get a return on equity of 20. If we don't, we get to 15. Okay, it just falls right out of the formula. It may help to see it graphically. Kind of intuitively, you see exactly what's going on in this example. On the y-axis, we have discount rates. Okay, we're in the world where we've got lots of different types of securities now. We've got assets, but we also have debt and equity. They're all earning different returns. It's not like the first week of class where we just had one discount rate to worry about. Now we've got lots of discount rates floating. So it's helpful to draw them out and see what's going on in a picture. In our simple examples, we can plot the discount rates for each of these pieces of the firm against the leverage, against the debt to equity ratio. Now, the debt we're going to say is constant, right? The return on the debt is just the same. If there's no risk on the debt, then it doesn't matter how much debt you take, you're still going to get the same return. Okay. Well, we'll vary this assumption a little bit going forward, but generally we just have a constant level for the debt return if there's no default risk. Assets are also constant, right? It doesn't matter how much debt you take, the assets are doing the same thing. So Apple's iPhone business is going to earn some returns, RA. Doesn't matter if Apple's using debt or equity or some combination. The iPhone business is generating a return, RA, and that doesn't change based on the capital structure. Okay, so that thing's flat. this was what I started with the accounting identities. I wrote it in terms of returns. So this has to stay the same. The assets don't change when you change your capital structure. So the return on the assets have to stay the same. If the debt return is staying the same and the discount rate on the assets is staying the same, then it just has to be the case, just algebraically, that we just proved, that the return on equity has to go up when we take on debt. Okay, and it's just this linear equation here. As you take on more debt, debt over equity goes up, so the return on the equity has to go up. The discount rate on the equity has to go up. We'll do another example just to work through the numbers again. With this company, we start with all equity. We have $20,000 in assets, no debt, and so $20,000 worth of equity. We're thinking about selling some debt. We're going to buy back some of our equity. How are we going to buy back some equity shares? Well, we're going to raise debt, use those proceeds from raising debt to buy back shares. So in this proposed scenario, the assets are still worth $20,000, but now we're going to raise $8,000 worth of debt. We're going to use that $8,000 to buy $8,000 worth of equity. Okay. That's going to mean that our debt to equity ratio goes from 0 to 2/3. Okay, you see, we're going to be using that here. The debt to equity ratio shows up there. We're buying $8,000 worth of shares, so that's 4/10 of the company. So the number of shares is dropping from 400 to 240. It's dropping by 40%. We're going to keep the share price the same just because that doesn't matter. But the number of shares goes down. The share price stays the same, so the equity goes down by the $8,000. Okay. We want to see what happens to the cash flows for the equity holders when you take on this debt and you have to pay an 8% interest rate. Just like Macbeth, you have to pay the debt holders first. In this proposed example, we have to pay the debt holders first. Just like Macbeth, we have different possible outcomes. Things could be good, things could be bad. In this case, we have 3 possible outcomes as well. We have a recession where this company is only going to generate operating profit of 1,000. In the expected case, we're going to generate profit of 2,000, and in the boom, we're going to generate profit of 3,000. Okay. Now, if we don't have any debts, we don't have to pay any interest, so we just give all of this to the equity holders. $1,000, $2,000, $3,000 go straight to the equity holders' pockets. If you have 400 shares to begin with, the earnings per share is $2.50, $5 and $7.50, and so we get these returns. The return on the assets is 5, 10, 15, which is also the return on the equity because we don't have any debt. Now suppose we take on some debt. We have $8,000 in debt, and we have to pay 8%. So that means that's $6,400 in debt, in interest payments during the year. Okay, and again, we have to pay that $640 in interest no matter what happens. Boom or bust, we have to pay the bank. What's left over for the equity holders is therefore the difference between the operating income and the interest payment. So now you only get $360 in the recession, but in the boom, you get $23.60. Calculate the earnings per share and the returns the same way. Okay. Notice that the return on the assets haven't changed. Those stay the same. Right? The assets are generating the same cash flows no matter what you do with your capital structure. But the return on the equity does look a lot different because now you're concentrating all of the risk into a smaller number of equity shares. Putting this into a graph, it's a little bit easier to see than in tables. The return on the assets is the same. Whether I use debt or not, the return on the assets is still 5, 10, 15 in the recession, expected outcome, and expansion regardless. Okay. Again, it doesn't matter based on capital structure because the assets are doing the same thing. What is going to change is the return on the equity. So in the current 100% equity financing scenario in blue, we had a 5% return when things are bad, 10% in the expected case, and 15% in the boom. If we take on more debt, well, what happens? Just like we said with risk and return, when you take on more systematic risk, right, the good times get better. So for equity holders, the good times get better, the bad times get worse. And in expectation, the returns also go up. Okay, so this is how you get a higher return. Again, think back to risk and return. You get a higher return when you take on more of the systematic risk. The equity here has a higher return, but that's because it's making the good times better and the bad times worse. Right? It all just falls out from this constant debt payment that we have to make, the interest payment that we have to make every scenario. It causes the equity to become riskier. So we've talked through these bullet points a bit. Are the ROA numbers the same? Yes, right. The assets don't change when you change the capital structure. So those are going to be the same whether you take on debt or not. The ROE numbers change a lot because you're squeezing all of the risk of the assets. You're squeezing it into a smaller number of equity shareholders now. Okay, and so that's why it looks riskier. As a bit of a quiz, a bit of a kind of pop quiz, check your understanding here. Ask yourself if the following statement makes sense. The earnings per share with debt in the capital structure is higher than with all equity. Okay, we saw that here. That's just true. The returns for equity are a little bit higher than the returns for debt and the expected outcome. So it's therefore optimal for firms to have more debt in their capital structure. What do you think? Recall M&M Proposition number 1. What did M&M Proposition 1 say? They said it doesn't matter. Okay, capital structure doesn't matter. It is not optimal for firms to have more debt. It just doesn't matter. So what's this business about the earnings per share going up? Well, that's because you're taking more risk. Right? You take more risk here, so the earnings per share goes up. But the total value of the firm doesn't change. You've just reallocated it to the equity. You've reallocated it to a smaller number of equity holders. So the correct answer here is that it's not optimal. It doesn't matter at all. The fact that equity holders are getting higher earnings per share in expectation, that's just to compensate them for the higher risk that they're taking. And these things are, they offset each other. It's not better one way or the other. You can see it visually by plotting the operations of the firm on the x-axis against the outcomes for the equity holders on the y-axis. Okay, so on the x-axis we have earnings, the y-axis we have earnings per share. So this is just for the equity holders. When we do this without debt, we get a relatively flat line. When we add debt, we get a much steeper slope. Okay, so what does this mean? This means that the equity holders are more exposed to the operations of the company. Right? Their fate is much more sensitive to how things shake up with the assets. If you don't take on debt, then it's not quite as sensitive. Right? So this feels a bit like systematic risk, right? We said that systematic risk is exposure to the economy. Right? With debt, you're increasing that exposure that the equity holders have to the operations of the company. You're increasing that exposure, and therefore you should be increasing the returns that equity has to get in order to bear that risk. This feeds in very well with what we just talked about with risk and return. When we said that you earn a higher return, we said that that's because you're taking more systematic risk, right? It has to be systematic risk. That's what generates a return, because that's very painful. Recall the two drivers of systematic risk, the fundamental drivers. Well, the first is correlation with the business cycle. Do your revenues correlate with the business cycle? That would mean that you have kind of systematic risk in your cash flows. But the second driver of beta is how many of your costs are fixed. What do you have variable costs so that you can cut back your costs if things are bad? Or do you have fixed costs, which means you have to pay those costs whether times are good or not? If you have high fixed costs, then that means that your cash flows are going to look very cyclical, because your revenues are going to be cyclical. And if you can't cut your costs, then that means that the cash flows are going to be very cyclical. Okay, so that was the second fundamental driver of beta. Well, what does debt look like? Well, debt's a very important fixed cost. Right? You can't cut your payments to the bank just because of a recession. Okay? You have to keep paying the bank. So that becomes like probably the most important fixed cost that you have. That means that when you take on debt, the systematic risk for the equity goes up because you have to pay the debt holders. You get this fixed cost. That means that whatever's left over for equity holders becomes even more cyclical. Okay, so this feeds in perfectly with our discussion of beta and systematic risk. Right? The times when you really want the money, you got to give it to the bank, and there's nothing left over for equity holders. Right? The times you don't really need the money, the very good times in the economy, that's also when the company is booming and you have no problem paying the bank and you got a lot left over for the equity holders. Right? But you don't really need the money. It's the times when you need the money is when it's all going to the bank and the equity holders can't touch it. Okay. Another couple pop quizzes here. See if we can understand propositions 1 and 2. Suppose that the firm can finance 50% of the operations with debt, and the bank is going to charge you an 8% interest rate. Well, clearly that's less than the cost of capital that shareholders require, so it's optimal to have more debt. What do you say? So one day when you become the CFO, you're going to have bankers approach you and give you this line. Okay, I can give you a big loan at only 8%, but your shareholders require, say, 20%. So clearly, you should take debt. Well, what would M&M number 1 say? M&M number 1 would say it doesn't matter. Right? In fact, if you take on more debt, your equity holders are going to require an even higher return. If they required 20% before, if you take on more debt, maybe now they require 25% because you've just diluted that. You've put more risk on the shoulders of the equity holders. You're giving all the safe cash flows to the debt holders, so the equity holders need even higher return. Okay, and these things offset each other. If you use more debt that has a lower cost of capital, that means that the cost of capital on the equity's got to ramp up to compensate. Okay, so it's not optimal, right? M&M number 1 says it doesn't matter, right? You can't increase the value of the company by taking more debt. Second bullet point, so clearly debt is less risky than equity, so it must be optimal to finance projects with more debt. What do you think? Well, same line of argument. Debt is less risky, that's true, but it's not optimal to use debt here. It just doesn't matter. You take on more of that less risky debt, equity becomes more risky, and that counteracts the increased debt. So let's take a moment to summarize. We've said that debt increases the risk to the shareholders. So debt is increasing the earnings per share and the returns. That's happening in good times. It's making the good times better, but it's also making the bad times worse. Debt harms the shareholders in the bad times. Again, just like any other fixed costs, just like we talked about with risk and return, that's a driver of beta. So both the earnings per share and the returns for the equity holders become more volatile when you take on more debt. And the increase in the risk is solely caused by that fixed cost. You just take more of a fixed cost, it just mechanically causes the risk of whatever's left to go up. Take 1 minute just to talk about risky versus risk-free debt. We've summarized with risk-free debt financing. We drew this picture before. We said that the cost of debt, RD, stays the same no matter how much debt you take. So if the cost is flat, that means that the risk isn't going up. I'm taking more and more debt, and I'm not taking on any more risk when I take on more debt. The debt holder's return doesn't go up. But at some point, you can imagine that when you take on too much debt, the risk of the debt goes up. Okay, so we can draw a picture like this. At some point, when you take on debt, the debt becomes risky. It's no longer risk-free. So when the debt becomes risky, as I take more and more, the debt to equity goes up, right, moving along the x-axis. As debt goes up, it gets risky. There's now a chance that I may default. So now the debt holders are taking some of the risk. The return on the assets stays the same. Again, this is M&M number 1. The assets aren't affected by debt and equity. The assets are what they are. The iPhone business is what it is. It doesn't matter how Apple chooses to finance it. So that's going to always stay flat in the M&M world. If the cost of debt is going up because it's becoming risky, well, that's got to come from somewhere. Something else has to change then if the cost of debt is changing. What's changing is equity. So now equity is still becoming more expensive when you take on debt, but it's not increasing quite as much anymore. You can see that there's a slight concavity here. The slope isn't as high when you take on risky debt because some of the risk is getting shifted to the debt holders. So the risk that gets concentrated for the equity holders doesn't go up quite as much as it would if we had risk-free debt. Okay, so at some point, this is all kind of in words spelled out. At some point, the debt gets risky. Equity also gets risky, but some of the risk goes to the debt holders instead of the equity holders. To summarize, we have two propositions that we've walked through, we've proved, we've seen some examples of this. The first proposition is that capital structure does not affect firm value. All that matters are the assets of the firm. Those generate the cash flows. That's what matters. Debt and equity is just a matter of cutting up those cash flows that the assets are generating. The second proposition says that debt and equity interact with each other. If you take on more debt, the equity gets more risky. The required return on equity goes up. Therefore, those future cash flows that are going to equity holders are less valuable because the discount rate has gone up. That followed very closely from the logic in our risk and return slides, because when you take on more debt, you have this fixed cost that you have to pay, good times and bad. That makes the residual cash flows that go to the equity holders more systematically risky. These conclusions followed from a few assumptions. Right there's these seven bullet points here. These are pretty strong assumptions. So what's going on here? These assumptions give us a benchmark. This is the standard. Modigliani-Miller, that's the standard by which we're going to measure everything in corporate finance. Everything having to do with capital structure gets measured against this benchmark. These strong assumptions then, we're doing a bit of kind of jujitsu. In jujitsu, you use the opponent's strength against them and you redirect it in a way that's advantageous to you. With these very strong assumptions, we're going to do something very similar. They allow us to focus on just these 7 things. These are the only 7 things that matter in finance. So if capital structure matters, it must be because of one of these things. And we can kind of think through each one piece by piece and see, what does it imply for corporate finance? That's where we're going with the rest of this lecture. We're going to focus on this first bullet point with taxes. We're going to see what happens if we introduce taxes. How does that affect our propositions? We're going to walk through the implications for Proposition 1, and then we're going to walk through the implications for Proposition 2 if we incorporate the U.S. tax code, essentially. Well, what is it about the U.S. tax code that has an effect on corporate finance? And really, for almost the rest of the semester, we're going to be focusing on measuring this effect. If we introduce taxes, that's going to have an effect on our decisions. We're going to try to be precise. We're going to be very rigorous in how we measure that effect on firm value. At the very, very end of class, maybe the last lecture or so, we'll talk about some other issues like bankruptcy and private information and how those may affect capital structure. But kind of the easy one to tackle first is taxes. That's something that we can put a number on. And so that's where we're going to spend the majority of our time for the rest of the semester. So starting here with corporate taxes, what is it about taxes that's important? We're going to relax one of those assumptions. We're going to relax the assumption on corporate taxes. We're going to see that these Modigliani-Miller propositions change when we allow for the U.S. tax code. Here's the issue. When we tax corporate profits, okay, EBIT here is taxed at the corporate rate, the earnings before interest and taxes. We tax that at a corporate rate. However, the cash flows that we give to our investors differs by the form of financing. Interest expenses can be deducted from your EBIT. Right, so this is earnings before interest and taxes. Interest can be taken out of that. So before you calculate your taxes, you take out the interest. That means that interest payments are reducing your taxable income, which lowers the taxes that you pay. That creates an interest tax shield. Okay, so these interest payments are not taxed at the corporate level because you get this deduction when you pay interest. That creates a tax shield, just like we had a depreciation tax shield when we studied free cash flows. Depreciation lowers your profits, which saves you money on your taxes. Well, it's the same thing with interest. Interest expense lowers your profits, lowers your taxable income, and thus lowers your taxes. When we think about equity, however, when we pay dividends, we don't get that tax break. That tax break only shows up when we pay the bank, when we pay interest on our debt, not on our equity. So you can kind of see where this is going. The tax code provides an advantage to debt relative to equity. So potentially the firm can create more value by using debt rather than equity because they'll be paying less taxes. So let's do an example. Let's walk through the numbers just so we see this once in a income statement. Dock this over here and then pull up the spreadsheet. We're going to think about changing our capital structure in light of this tax code. Suppose that you own the entire company, you own all of this Space Babies diaper company. It is completely equity financed, so there's no debt and you own all the equity. The company has earnings before interest and taxes of $1,000, and we have a corporate tax rate of 40%. Okay, so let's just write this out. EBIT of 1,000. We have a tax rate of 40%. If we have all equity financing, so I'll indicate that in the top row, 100% equity, that means we have no interest payments. Our interest expense is 0, which means that our taxable income is the $1,000 EBIT minus the interest expense. Okay. With a tax rate of 40%, how much are we going to pay in taxes? Well, we pay 40% of the $1,000 in profit. So $400. How much money is left? We have to pay $400 in taxes, so the company only gets to keep the $600. What you're thinking about doing is you have this situation right now. You are going to get a cash flow of $600. You're thinking about exchanging some of your equity for debt. Okay, so you're still going to be the same. You're going to be the sole owner, but maybe it makes sense for you to give the company a loan instead of equity. So the way you can think about this is you're giving yourself a loan to pay back your equity. Okay, you're still the sole owner. You're just writing the contract differently so that some of it's in debt, some of it's in equity. Okay, so you're going to exchange half of your equity for bonds with a face value of 1,000. We have a interest rate on the debt of 10%. So what's going to change if we use 50% debt and 50% equity? Well, the operations don't change. So we still have the EBIT of 1,000, right? That's our operating profit. That stays the same. Our interest expense is going to change. If we have debt with a face value of $1,000 and an interest rate of 10%, that means we have to pay 10% of $1,000 in interest. So that's $100. Okay. You can put in any kind of number you want. We're just making up numbers for interest expense here. But for this example, we have $100 interest expense. So how much is our taxable income? Well, we have the money from the operations of 1,000 minus the interest expense. Our taxable income is only $900. our tax rate is the same. What we'll see is that we're going to pay less taxes now because our taxable income went down. So what's the cash flow? Well, we have $900 in taxable income. We paid $360 in taxes. So we have $540 that is generated for the equity holders. Before we were all equity, so that entire cash flow was available for equity holders. What's the total cash flow that goes to all the investors, however? And this is the crux of the issue. Well, if you have all equity, then the cash flow available for the equity holders is the same as for all the investors. That's the only investor you have. What other investors have we paid when we use 50% debt, 50% equity? Well, there's this $540 that we can give to the equity holders, but where else did cash go? Well, it went to our debt investors. We paid them $100. Okay, so how much total can we give to our investors? Under this capital structure, we can give $640 to the investors when we use debt, whereas we could only pay $600 to our investors if we used equity. That creates what's called an interest tax shield. The difference here is money that we didn't pay in taxes. That $40, we didn't pay that money in taxes, so that saved, that created more cash that we can pay to our investors. More generally, we can write out the interest tax shield like this. You have an expense, you have your interest expense, and you multiply that by your tax rate. This interest expense is lowering your taxable income. So every dollar that you lower your taxable income, you've saved your tax rate in tax payments. Okay, so if you lower your taxable income by $1 because you have $1 in interest expense and you've got a 40% tax rate, then you've created an extra 40 cents that you can give to your investors because you've paid 40 cents less in taxes. Okay. Sometimes the interest tax shield is abbreviated ITS. I'm going to do that a lot in this class for brevity. Another way you can write it with you can replace the interest expense and try to calculate how do you generate debt. Well, what is the interest expense? It's the debt that you're paying times like the interest rate on the debt. You put those two things together to get your interest expense, and then you multiply that by the tax rate. We're going to see this a lot through the rest of the semester, calculating the interest tax shields that investments generate, and then we're going to value these things too. So let's do that for our kind of Space Babies example. We have this interest tax shield of $40. Let's try to value that and see how much the total value of the firm changes when we take on 50% debt. So suppose that this happens in perpetuity. Suppose that we're going to get this $40 in perpetuity. We're just going to keep the debt at 50% indefinitely, and we're just going to get all of these cash flows forever. Okay. Just to keep things simple, just view it as a perpetuity for now. Okay. How can we value the tax shield? Well, we're getting $40 every year, and if, say, the discount rate on the tax shield is 10%, then we can value it as 40 divided by 0.1. Call this the value of the interest tax shield, VITS. That's going to be the $40 that you're getting in perpetuity divided by the discount rate on the interest tax shield. So 40 divided by 0.1, that gives us $400. You, as the sole investor of Space Babies, you're able to increase the total value of your holdings by $400 by simply replacing half of your equity with debt. You're giving yourself an extra $40 every year forever. So we're going to do exercises like this, again, a lot. We want to focus on this tax shield to think about how much exactly can our firm value change through finance, through capital structure. So that's all laid out here in these slides. Again, we're just simplifying this Space Babies example, saying that everything's going to occur in perpetuity. We're going to use the discount rate of 10% to discount the tax shields. That gave us a present value of all of those tax shields as $400. You can walk through the math a little bit more if you want. We calculated that the interest tax shield can be written as debt times the interest rate times the tax rate. That's what's in this numerator here when we calculated the present value of the tax shield. And then we're dividing that by the discount rate on debt. So what you can see is that these discount rates cancel out for this simple perpetuity. And so the value of the tax shield is the debt that you're taking times the tax rate on the debt. So this $400 that we calculated before, that's equal to the $1,000 in debt that we're taking times the 0.4 tax rate. That would be another way to get it. Again, this is a very simple assumption that things are going to occur in perpetuity. But sometimes you'll see this, that the value of the company can rise by D times T due to the tax shield. Okay. That means that the total value of the company can be written as the value of the company unlevered plus the value of the tax shield. I'm going to spell this out a little bit more. The value of the company with leverage, so it's a levered company, you have debts, right? Levered just means debts. Let me say that here. How much is the company worth if you have debt? Well, it's going to be the value of the company without debt, so unlevered, VU in this notation, plus the value of the interest tax shields, ITS, which in this case was just debt times T because it was a perpetuity. Okay. Our Modigliani-Miller conclusions have now changed. You see that here, that the value of the company with debt is no longer equal to the value of the company with no debt. It's equal to the value of the company with no debt plus the value of these tax shields. Okay. So this is where we're left with. We also see that Proposition 2 changes. Okay, so Proposition 1 with corporate taxes is that the value of the company goes up when you take debt. Proposition 2, we'll derive this later, so don't worry about this formula right now. We'll spend a lot more time on this formula after the second midterm, so don't worry about it. But what you do need to kind of recognize is that this formula looks different from what we saw before. What's new is we added this 1 minus T term on the debt over equity ratio. Right, Modigliani-Miller number 2 says when you take on more debt, the cost of equity has to go up. The discount rate on equity has to go up. Right? That's still true here. When we take on more debt, the cost of equity goes up. The discount rate goes up. However, it doesn't go up by as much as it used to. We're multiplying this ratio, debt over equity, by 1 minus the tax rate. That means that the cost of equity doesn't quite go up 1 for 1 with debt to equity. It goes up less than before. It goes up some fraction. So if your tax rate is 40%, then your cost of equity is only going up 60% when you change your debt over equity ratio. It only goes up 60% of what it used to go up. These were the old propositions. Like the value of the levered company is the same as the value of the unlevered company. And we had the cost of equity goes up with debt over equity. But now when we allow the tax shields, the value of the levered company is higher than the value of the unlevered company. And the discount rate on the equity doesn't quite go up as much when we take on debt. This was the old picture, right? The cost of the asset stays the same, the cost of the debt stays the same, but the cost of debt or the cost of equity goes up when you take on more debt. The new picture shifts that cost of equity down. It doesn't quite increase as steeply. Why? Because you're getting the tax shields, and the tax shields are good for equity holders. Right? Part of that tax savings can be paid to the equity holders. And so when you take on more debt, equity holders don't mind it as much. It still makes the equity more risky to take on debt, but it's not as bad because at least they're going to get some of those tax shields. Another thing that's different is the discount rate on the assets. Before we had that all that matters are we had that the assets don't change. The return on the assets stays the same no matter what's going on with the capital structure. Now we have that the discount rate for the assets is going down because you're saving money on taxes. Another way to think about this is that there are some projects that you wouldn't have taken before. Suppose you have a project that earns a return here, where I'm pointing with my pointer here. Okay, that would be below the discount rate on the assets with no debt. Okay, so you're right here. Before you wouldn't take that. However, if you can use debt, what happens? Well, if you can use enough debt, then the return at my pointer is going to be higher than the discount rate for the assets. Well, why is that? Well, it's not a good project, but if you use debt, at least you get tax shields out of it. And so those tax shields may push you to take projects that you wouldn't have taken before. So we'll study this a lot more after the midterm. What this is called is the weighted average cost of capital. That goes down when you take on debt. Some projects are going to look okay just because you get the tax savings out of them. If we revisit this kind of pie example, if we think about the value of the company as a pie, before we said that it doesn't matter, the size of the pie stays the same. But here, what matters is the government is taking a cut. So let me throw up a pie here. So suppose you used all equity. Maybe the pie looks like this. You have 100% equity, no debts, but you have to pay the government's, 30, 40% of your profits. Okay, so the government's getting a slice of the pie now. What happens if you use debt? Well, now we get a picture like this. If you use debt instead of equity, the total size of the pie can still stay the same. That's fine. Arguably, if the tax rates go down, the size of the pie grows. But keep the size of the pie the same, just to fix ideas here. If you take on more debt, well, you're giving less money to the government. The government gets a smaller piece of the pie, and so that's good for the investors. Right? You're giving less to them. Investors get to keep more. Okay, so even if the total size of the pie stays the same, you prefer to use debt because now government gets a smaller share. You can think about a pop quiz here. What would be the best thing for investors? If we change Modigliani-Miller to allow for corporate taxes, what would be the best way to finance a company? In this setup, the best way would be totally debt. Right? If you use as much debt as possible, you're minimizing how much you pay in taxes, and so that's the best thing for your investors. Right there, there's no kind of offsetting effect that we've talked about here. It's just a one unidirectional effect. More debt means less taxes. That's good for investors. Again, at the very end of class, we'll talk about bankruptcy costs and things that may push us in the other direction. But for now, if all we're thinking about is the tax code, more debt is better. We're going to conclude with a little bit on personal taxes. We saw that corporate taxes create a wedge between debt and equity. Corporate taxes give preference to debt, so companies want to take more debt. Well, it's possible that personal taxes do something similar. As an individual investor, if you're taxed differently on your equity investments versus your debt investments, then perhaps you prefer the firm to have more of one or the other. So we can look at the same wedges, right? The same type of wedges in the tax code and think about how that affects our decisions as firm managers for our investors, right? We want to do the best thing for our investors. That's going to depend on what they're doing with what's happening with their taxes. So Merton Miller extended the above model for personal taxes. he came up with this ugly equation. So don't worry about kind of memorizing this, but we want to talk through the logic a little bit. We have the value of the company with debt on the left, just like before. We have the value of the unlevered company. Okay, so Modigliani-Miller Proposition 1 says these two are equal. When we introduce corporate taxes, then we added on this extra term that got multiplied by the debt. When we take on more debt, we increase the value because of the corporate tax code. That's tau C, that's the corporate tax code. If we get rid of all this other stuff, we have the value of the levered company is equal to the value of the unlevered company plus the value of the interest tax shield, right? We have this thing before. Okay, so if we get rid of all the personal tax rates, that's where this equation gives us. However, we're introducing two new tax rates. Tau E is the tax rate on individual investors on their equity investments. So think about dividend payments and capital gains. Those get taxed, and so those would be included in Tau E. On the other hand, we have taxes on personal investors' debt payments. So when the company pays interest on their debts to personal investors, investors have to pay a tax rate. Let's call that Tau D. So the total value of the company then depends on how individuals are taxed as well as how the corporation is taxed. In particular, if personal investors are taxed less on their equity than on their debt, then that's going to offset some of the interest tax shields that are embedded in the corporate tax code. Okay? So you can use this equation to kind of think through it a little bit. In practice, personal investors are taxed less on their equity than on their debt. Generally, when you buy a bond, you get interest payments on those bonds. You have to pay taxes at your ordinary income rate, which could be 30%, say. But with equity, you're usually taxed on capital gains or dividend income is usually taxed at a lower kind of special rate, maybe only 20%. And further, when you own equity, you don't have to sell your stock. You can just buy and hold for a long time, and then that means that you don't get taxed until you finally sell the stock somewhere down the road, and you pay taxes on those capital gains, but that's deferred, right? That's very far out into the future if you're buying and holding stocks. So for a variety of reasons, equity is going to be taxed less than debt generally for personal investors. So that's going to offset some of this tax savings that you get from debt. It's unlikely, however, if you work through the equation, it's unlikely that equity is going to be preferred. We can walk through, if you think through this equation, when is debt going to lower the value of the firm? Well, the value of the levered company is equal to the value of the unlevered company plus this kind of ugly bracket times debt. So in short, when is this ugly bracketed term negative? If this thing is negative, that means that the value of the company is actually going down when you take debt. If you work through it, how can you get this bracket to be negative? Well, you can, you need this fraction to be greater than 1 in order for the bracketed term to be negative, which gives us this implication. What we need is that 1 minus the corporate tax code has to be higher than this ratio of 1 minus the tax on personal debt income divided by 1 minus the tax rate on equity income. And so generally, this is going to be hard to satisfy, even if you're not taxed on equity at all. Suppose that this tau E is 0, so you're not taxed on equity at all. Well, you would still need that your tax on personal debt income would be higher than the corporate tax rate, which is generally, it would be hard to sustain that. And once we factor in that equity investments are taxed, it would be very hard to get this ratio to hold. So generally, debt is still going to be preferred, but once we allow for some personal tax issues, that preference goes down a little bit. In practice, it's hard to do this kind of exercise. What you'll see in the rest of our classes, we'll think a lot about corporate taxes and the interest tax shields from that. In practice, we're not going to consider personal tax rates. The main reason is that it's very hard to know who your investors are and what their tax situation is. So for most of us, our investments are in like 401ks or pension funds. So these are tax preferred accounts. You're not taxed on those until way down the line. And you can shift your investments all you want in the meantime, and then only pay taxes when you kind of cash stuff out of your account. So to think about what is the tax rate of your individual investors, it's not so easy to get at that. So generally, we don't pay attention to that in corporate finance. Main takeaways for this whole lecture: we should understand propositions 1 and 2, kind of with and without corporate taxes. So if there are no corporate taxes and all those other assumptions hold, then capital structure is irrelevant. You can't add any value by taking on debt or playing around with your capital structure. Also, Proposition 2 says that cost of equity goes up when you take on more debt. If there are taxes, however, then we're getting a tax shield when we use debt. We get that interest expense lowers our taxable income. We pay less in taxes. Therefore, we have more money to pay to our investors. That's a good thing for equity investors too. Equity benefits from those tax shields. And so the risk of equity actually doesn't go up as much as it would otherwise. With M&M Proposition number 2, the discount rate on equity still goes up when we take on debt. But if equity holders get those tax shields, it doesn't go up quite as much. We should understand the basic formulas, right? Getting the discount rate on equity is a function of the company's leverage. We're going to see that a lot going forward. We should understand the personal taxes a little bit, just intuition. Again, we're not going to use this formula, but you should understand the intuition that if personal taxes favor equity, then that's going to reduce the benefit from debt. With the intuition from Modigliani-Miller, you should be able to think through these graphs. You should see how the discount rate on equity increases with debt to equity. And we're going to talk about this a lot more going into the future. So this slide deck is kind of our starting point for capital structure. Going forward, we're going to be thinking about how to value those tax shields more precisely. And we're going to also be thinking about things that offset the tax shields, right? You don't see firms that are financed with 100% debt. Why not? Okay, so that's the roadmap for the rest of the semester.